What's going on, guys? Mike here, and in today's episode we're going to be talking about one of my largest holding ETFs that I have between my RSP and my TFSA, and that is XEQT. Now, before I get into the deeper dive of the XEQT, I do just want to highlight a common mistake that everyone seems to make, and that's that there's three different kind of flavors of this particular ETF. So there's XEQT, that is 100% equities or 100% stocks. And then you have XBAL, which is 60% equities, 40% bonds. And then you have XGROW, which is 80% equities and 20% bonds. So I just wanted to highlight that because, like I said, quite a few people do make that mistake where they'll start with, say, XBAL or XGROW thinking that it's more of an aggressive approach, and then soon realize that the returns aren't what they were looking for, and then they want to switch. Then there's the question: well, do I sell what I have and start buying XEQT, or do I keep it and then just start putting all the new money into XEQT, and so on and so forth. Now, me personally, one of the reasons why I went with XEQT is because I wanted to have more control over my bond allocation. Because again, someone that starts with, say, XGROW and then gets closer to the retirement, and then they are like, well, now I want 40% bonds and 60% equity. So now XBAL is more of what I want. So it's like, again, do you sell it and then start buying into XBAL, or so on and so forth. So again, I went with XEQT because I bought an individual bond ETF, so I can easily control my bond allocation, right? So if right now my RSP, I am 90% equities and 10% bonds. So, and if I want to increase that, well, it's very simple, because then I can just start allocating more money to bonds in my older age to bring up that allocation, right? So it kind of makes sense, right? Again, you need to do what works best for you, but that's the main differences when choosing between XEQT, XBAL, and XGROW. Is just they're all the same equities, but just a different allocation in bonds. So hopefully that helps. Anyways, let's just dive a little bit further into XEQT. So I just have it starting here on the Google homepage, and I just kind of want to highlight, because the number one question, because everyone loves it, is dividends. Does XEQT pay dividends? So looking at Google, it's empty, but they do pay dividends. So you look here in 2022, if you add this up, they actually ended up paying roughly around 51 cents per share, and based on the current share price, that works out to be around 2%. So again, they do pay dividends. It is not their main feature, though. Their feature is more of like a capital growth, and that is globally diversified. And we'll get into those details here in a few minutes. But yes, so the fact of the matter is they do pay dividends, and it is quarterly, not monthly. The other thing I wanted to point out is that some people get a little concerned is because the dividends does fluctuate. So you can see, the start of January is 8 cents, and then 19 cents, 7 cents, and then 16 cents. That is just because the underlying assets are all paying dividends at different times, right? So that's why there's that fluctuation, and again, is no concern. So yeah, hopefully that clears that up for you. But heading over to the actual iShares website, you can see that their year-to-date is different. It's actually at 7% compared to at the start here being at just below 6%. Again, I just want to kind of highlight that so many people make this mistake, and they just see this and they think that's the actual return. But when a holding does pay dividends, the Google site here on year-to-date does not include that. So again, they're actually at 7.08%. For the year, that's including their dividend payments. So just as a reminder for you guys there. I do want to start with one of the main features that I really like about this particular ETF is its low cost. So you can see here at 0.2%. Now, before I kind of made the change over to XEQT, I was personally invested into kind of mutual funds, growth ones and balanced ones, and I was paying 2%. So when I made the realization that I was paying 2% and I could go somewhere and pay 0.2%, it sparked my interest. Right now, there are some pros and cons that I'm not going to get into too much detail here, because I'm going to actually have another video that comes out with the comparison of mutual funds and ETFs. But the reason why it's so much cheaper, because this is another major question that people always ask, is because ETFs are passively managed. Okay. And mutual funds are actively managed. So Sometimes during like volatility in markets, active can be better because they're buying and selling, and things are going to drop. They might lower their allocation to that sector and move it somewhere else. Whereas the ETF, it's typically kind of, again, I said it's passive, so it's kind of more of like a set and forget on the management side, right? So they kind of like do adjustments every like once a quarter, or sometimes maybe more often, sometimes less, depending on which one you're going into. But one thing, again, I don't want to get into too much detail of this, but one of the things that made me say that was okay was that over the long period of history, passive typically outperforms active. So again, I'm gonna have a video that comes out on that that explains it a little bit more better. But just note that that is the biggest reason why you're paying less fees, because they're passively managed versus like active. So active being like daily, right? So just take that for what it is. So going down a little bit further here, again, this is just going to kind of mix into the management fee. Is the other next largest thing that people talk about is, okay, so you pay 0.2% fee on XEQT, but I'm now realizing that XEQT holds other ETFs underneath it. That's what it does. It doesn't hold the equities directly, it holds other ETFs underneath it. So the answer is no, you do not pay the additional fees for these ETFs, because those are all funneled up to the 0.2% MER. So hopefully that clears it out if that's something you guys are looking to get answered. But the cost that you pay is the MER on this website, which is 0.2%. So again, kind of going back to one of the other reasons why I chose to go with XEQT over the mutual funds that I was in, is I noticed that they all hold roughly the same thing, right? So you'll see here when I do the aggregated holdings, it holds Apple and Microsoft and Royal Bank and TD. And if I go over to a growth portfolio, you'll see here from RBC, Microsoft, as well, Apple, Royal Bank, TD, all the same things. The only thing that's kind of different is like sometimes the asset weighting. So you can see here, so like Microsoft's at 1.8%. And if I go back to this guy here, you can see Microsoft's at 2.3%. So there's slight variations, but typically they all hold roughly the same thing. One of the biggest things too to realize is that when you buy into this ETF, you're actually buying a slice of 9,367 different companies. So now we're going to kind of talk about the diversification aspects. So 9,367 equities. So by one purchase, you get exposure to an obscene amount of different equities throughout the world, which is amazing in my opinion. Now again, this happens also in mutual funds. It's not exclusive to just ETFs, but this one in particular is a global diversified ETF, meaning that you are buying into like the world indexes at this point. So looking at that, you can see here they have the bulk of their money into the United States at 43%, and Canada being the second biggest holder at 24%. And then basically the rest of the world underneath. Now, so it's one of the things I've been talking about lots in this channel is diversification. And, it's so important to be diversified, not just by country, but also by sector. So just kind of looking here, this is on the Morningstar website. This is the sector investment that they do. So you can see over a course of a few different sectors, utilities, healthcare, consumer defense, real estate, financial services, technology. I've stressed on my my DIY investing videos about not being more than 5% in a stock and 20% in any given sector, and they typically follow this as well, right? You can see that their highest allocation being in financial services at 18%. So again, if the financial industry is having a problem in the U.S., well, you're going to have, say, 40% in that country, and then a small percentage of that actually being in their financial services. So you're so well diversified that you're probably not going to overall see crazy amounts of like movement, right? So being diversified is so important. Okay, going over the performance of XEQT, they actually, I think, started like the actual XEQT ETF in 2019. So it's kind of hard to kind of get like a really good benchmark as to how they've done over the past years. So what I've done is on this portfolio visualizer website is I actually took the holdings that they had, which is, if I go back right here, go to the top 10 holdings, you can see ITOT, XEF, and so on and so forth. I ended up plucking those all into here, and I dated it back to 2017 and put the allocations. Now, this isn't going to be perfect science because, maybe they had a little bit more of XEF, or something, or like, if it would have existed back then. So this is just to give you a rough idea. But if we look down here, before we also go down, I also have VFE for kind of like an SP 500 benchmark. And then I also have VCN, which is the Canadian index. And so I have 3 portfolios. Portfolio 1 being XEQT, and then the portfolio 2 and 3 being the kind of the benchmarks. So just looking into this, you'll see here that portfolio 1 being our XEQT variant came in at a compound annual growth rate at 9.03% since 2017. Now you'll look at the SP 500 and it came in just under 12%. Now, no argument, SP 500 hard to beat over these last couple decades, really. They've had an amazing growth cycle, basically since 2008. So yes, the specific country, just the US, their index has outperformed XEQT. But you'll also notice that, on portfolio 3, which is our Canada portfolio only, I got 7.42. So again, I just kind of want to highlight the diversification part of this, right? Yes, if you had all your money in the SP 500 US market, you would have came out on top. But it also does incur additional risk, right? Because if the US crashes and has, a decade of bad years, well, you're also going to suffer from that, right? Whereas if you're in XEQT, only 43% of your money was in the US, meaning the other 60-ish% of your money is maybe in a market that is still growing, right? So maybe it'll offset those losses and you'll come out, par. Or maybe you'll have a few positive, percent each year because the bulk of the money still is in the US. Now, again, if you had all your money in Canada, again, diversification is so important, you would have actually come out way less than the US, or you would have come out in the middle with XEQT, right? So again, I just want to highlight the diversification that comes from this. And in my RSP and my TFSA, I hold 70% of my money in XEQT. And then I use the rest of that 30% in varying different ways, right? So like in my RSP, I do 10% bonds, and then I have 20% where I kind of play a little bit more with. So my TFSA, I have 70% XEQT, and then I do the rest of it actually in individual stocks, right? So the bulk of my money though is in XEQT, where I feel that it's managed by professionals, and if I do something wrong, say on the kind of the individual stocks or whatever, I am still covered by having such a global diversified portfolio that I can rely on. So I hope that was helpful. So that's kind of the main reasons why I chose XEQT. One of the biggest realizations though is that XEQT typically is never going to beat the index. So if your goal is to beat the SP 500 or other indexes, the SP 500 the XEQT typically mirrors very close to the same directions that any index is going. So if the world economy is going up, you can expect the XEQT is going to follow that, right? If the world is going up and the US is going down, you're just not going to have as a steep of a curve, but you're probably still going to be okay, right? Because 60% of your money isn't in the US. So that's what I'm just trying to say, is that if your goal is to beat the index or a index, XEQT might be a hard one to use, right? You might need to have a different allocation for that. But if your retirement is banking on the world stock market average returns, then XEQT is a great option for you, and so on and so forth. So I hope you guys found this helpful. This is the reason why I invest in XEQT. I love the diversification and so on and so forth. So hope you guys found that helpful, and we'll talk to you guys next time. Catch you guys later.